concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
We are going to get the spoken word now on the stock market with our chief equity strategist, John Blank, who is sitting right here next to me this time, fresh in from the West Coast.
Yes,
I always
sir.
like when you come into the studio because then I can pick on you more than I have time for when you're Skyping. But we'll try and make this painless for you. So the headline on your market overview for the summer is the summer of 2015. Story is consumer spending. Now, along those lines, the market was recently jarred, you know, by the unexpected fall in June retail sales. What do you think of that?
It's a monthly number, and you know it's speaking to the problem we have to worry about, which is cautious consumers. Consumers have certainly been more cautious than we would like them to be. But the good news about that is they're saving, which is a good thing. And the good news about the caution is it's still a 2.5% annual growth rate for the economy and for consumption generally, which is weaker than you'd like to see, but strong enough to keep us well out of a recession. So I think the message from the market is when you get to this stage of this cycle, 6 years in, 7 years into a cycle, 5.5% unemployment, you just don't have that much more uplift. And so it just kind of, just like a S-curve, it just kind of planes out towards that optimum level of 4.5% unemployment and whatever growth rates there. So you just don't, you know, when you're going from 9 to 5 unemployment, you have a huge amount of slack to pick up and a lot of growth to see. But when you're going from 5.5 to 5 to 4.5 over 2 years, you're just getting a slower growth profile. So there is most definitely a cyclical bias in the stock market. You see it in mid-cap growth stocks and small-cap growth stocks versus small-cap value stocks and mid-cap value stocks. And you see nothing out of the large caps, which all of that in one totality of data tells you there's this modest cyclical bias towards growth in the economy, but the effect of the strong dollar on the bigger companies and the just sheer lack of upside for them is pulling back on that growth rate.
All right, we got a lot of ground to cover here with regard to the market because a lot has happened since you and I have talked like this. Greece, let's talk about Greece. Non-issue for the market at this point?
Issue for the market. It remains an issue because we have yet to see the banking sector there open.
Okay.
So yes, the deal has passed. Yes, the IMF's arguing about debt restructuring, which is a good thing. But what I am worried about, and the market should worry about, is they've had the banks closed 2 weeks. They're going to get a bridge loan in. We got to see what happens to Greece. They have literally shut the economy for the last 2 weeks. And I am not convinced that you just open the economy like a mall and start doing business. There's got to be repercussions, and we still don't have a real clean exit from this whole period. So there could be some turbulence for a good 8 or 10 weeks before we see an exit from this whole affair between Cyprus and the EU.
All right, we're talking here on July the 16th.
Right.
This week, Janet Yellen gave her economic testimony to Congress. 2 days worth, non-event.
Non-event. Terry, we've discussed this before. The reason that it's a non-event is the same reason we talked about earlier about the GDP growth rate. Later in the cycle, lower interest in tone. Stocks aren't going anywhere, and the interest rate they're going to raise on the short end's been 0, basically, for 6.5 years. We're going to go to 25 basis points. Whether it's September or December is irrelevant. All we know is that as long as the ECB has put the stake in the ground next September for QE, the next year is basically a non-issue for interest rates. Anyways, they might get up another 25 basis points on top of that 25 basis points, but 0.5% of interest from 0 isn't going to rock the markets. And the 10-year is telling us that. The U.S. 10-year is at, what, 2.4, 2.3, 2.2. None of that is telling us, when you add a 2% inflation rate, that you're going to get anything more than 50 beeps out of the actual raise for the next year or so. So I think it's really a matter, just like retail sales and the 2% growth rate in the economy, of just not that much concern at this stage. That can change in a year. But right now, I wouldn't worry about it.
We'll take your word for it.
Yeah.
That brings us around to the Q2 earnings season. Any impact, or I should say, what impact is earnings growth or non-growth going to have on the stock market here?
Well, we're getting into trickery here. We're seeing a lot of stock buybacks holding up the market and a lot of revenue growth not showing up. right? I mean, you're seeing, again, revenue growth at a 2% rate, which is not great. But you're getting earnings growth a little higher because you're doing stock buybacks. Profits are reasonably strong. And so, again, it's a matter of managing down expectations. It might be a 5% year for the S&P 500, as opposed to a 15% year last year.
So getting back to the original point of how we opened this conversation, story for the market for the summer of 2015, consumer spending, right? Consumer discretionary sector taking off, on the rise.
Correct.
But what is behind that strength? Is that real strength that we're seeing?
Absolutely. You've got a housing boomlet going on because the rates are rising shortly. So everybody's getting in front of that. They think now's the time to lock in a rate, buy a house. So we're seeing a fair amount of construction spending. We're seeing the same thing happening with automotive spending because you say, well, I'll get a car loan now, it's cheaper. And you're seeing a 17 million annual rate in car sales. Haven't seen that in years. So overall, when you have a low unemployment rate, a decent level for the stock market to take some discretionary income out of your stocks, and a general feel of confidence that things are going to go well, you're going to see this kind of modest cyclical lift.
All right, quickly, Pep Boys, one of the stocks in that sector you're looking at.
Pep Boys, great example of a stock. It's in the auto space. It's in the do-it-yourself auto space. And it's got about 700 locations across the country and in Puerto Rico. This is the kind of thing that has been really taken off. AutoZone, Pep Boys, these types of things. So this is Zach's ranked #1 stock, and it's a great example of the kind of cautious discretionary spending that's going on. Yes, I'm interested in upgrading my car. Yes, I like to do custom things, but the bill I'm looking for is $500 to $1,000, not replace the car.
Okay, another very attractive sector for you is healthcare, and in that sector, Acadia Health is one you're looking at.
Acadia Healthcare, based in Franklin, Tennessee, been a very consistent Zach Swank #1 stock for a number of months now. What they are, you know, they're benefiting from the retiree boom. As we see the labor participation drop, we're seeing more and more people enter the retirement ages. And a lot of these people are wanting not only better care, better nursing homes, and a lot of custom operations and drugs and other things. Places like Acadia Healthcare are dealing with that, packaging it and selling it to these people. And they're doing really well, and they're growing very strongly.
Okay. You also say utilities providing a balance, but I want to move on to something a little bit more timely as far as news is concerned. Energy fell to an unattractive rating, you write, even given the recent Iran agreement?
Well, Iran getting access to the global markets with its oil supply, they were one of the founding players in OPEC long, long ago, along with the Iraqis. So as these things start to evolve and get the supply up, you're going to see another leg down for the oil price. So now we were at 60, now we're shooting down towards 50. And yet again, we're still not seeing any uplift from the consumers. What that's doing is kind of lowering the growth rate for the oil exporters of the world. But net on net, you have to say that this is going to be a positive. I saw this morning a beat for an Indian food company selling rice in places like Iran will happen to be a big rice buyer. So a lot of people are going to be selling stuff to Iran away from oil. Then this is something that will be a very strong thing for the market in that region. And hopefully that's where we head. They have a lot of consumers. There's tens of millions of people in that country. They're fairly sophisticated, and they actually are Western-oriented. So that's the good news. You get away from oil, again, there's probably going to be some spending upside there.
All right. Wish we had more time. We could talk about this all day, but we got to call it for time there. Thanks, John. There you have the spoken word on the market for the summer of 2015 and other things that impact it with John Blank. I'm Terry Ruffalo.